Hey guys, welcome back to another video. My name is Josh and today we'll be taking a look at Summerset Group Holdings Limited. So Summerset is one of my largest positions in the public portfolio. So I thought it'd be a good idea to provide you with some of my thoughts around the company and to sort of go deeper into the numbers and into the business to give you an idea of what Summerset does and why it could be a good stock for you and your portfolio for the long term. So let's get into this video. So Summerset Group Holdings Limited trades under the stock ticker NZESUM. Firstly, I'll go through the company overview. We'll take a look at the business and what the business does. We'll look at the industry and the competitors there. We'll also take a look at valuation, and after all that, we'll round things up with some of the risks involved with this stock and summarize everything up in the video as well. So first of all, before we continue, I'm not an authorized financial advisor and I'm not liable for any mistakes made in this video. You should always do your own research before investing. I do own shares in Summerset Group Holdings Limited and on the public portfolio, as well as in my private stock market investing, right? So I own shares in Summerset, and if you enjoy content like this, be sure to like and subscribe. This video took a very long time to make. I was thinking of already making this video a few months ago, and you'll see later on why I should have done that, but it took me a while to make this video. So if you appreciate the work that I've done here, be sure to like and subscribe. Quickly, Summerset is an retirement village operator. They own, they operate, they build, and they provide quality retirement village and aged care services to older New Zealanders. Summerset listed on the NZX in 2011 at a stock price of $1.40. Currently, they're sitting at $7.25 per share. And Summerset is the third largest retirement village operator and the second largest developer of retirement villages in New Zealand. Let's take a look at the operations of the business as well as some of the competitive advantage of Summerset that it has over its competitors. So how the business works, there's four sources of revenue, realized revenue that Summerset makes money from. And I'll also talk about the key drivers. So the first one is realized development margin. So a realized development margin is the margin obtained on cash settlement of an occupation right agreement following the development of the unit. So if you think about it simply, for example, Summerset takes $200,000 to build a unit and they sell it for $300,000, and that's basically a development margin of $100,000, the difference between the sell price and how much it costs them to develop that unit. And so the key drivers of this source of revenue is property prices. If property prices are high, it will increase their valuation, and so the unit valuation would also increase. And secondly, keeping the cost of development low. The second one is care fees and village services. So when someone buys the unit for $300,000, they stay at the unit, and every week they have to pay a fee for basically for maintenance of the village as well as any care fees that they incur. And the key drivers for this type of fee is the level of care you require. So obviously the more extensive your care is, the more you'll pay. And also occupancy rates, so how much of the units are fully utilized. So, if you have occupancy rates at 80% versus 90%, so 90% you would expect to generate more care fees. And thirdly, we have deferred management fees. So deferred management fees are basically fees incurred by the residents for the right to occupy a unit under an ORA being the occupation right agreement. And this fee is amortized over the estimated tenure of residence. An example being the $300,000 that I paid to move into the village. What Summerset does is they amortize 10% every year. So each year for the first 3 years, Summerset will take 10% of that. So $300,000, 10% of that is $30,000, and for the first 3 years, that would add up to $90,000. Beyond 3 years, the amortization rate is 0. So it's standard that all other competitors charge a 10% per year for the first 3 years and 0 after. And so at the end of the life of the resident, when they move out, Summerset only pays back the remaining amount. So they pay back $210,000 to the person, to the estate of the family, right? So they keep 90,000, and that's the deferred management fee. So the key drivers for that is the cost of an aura, and as well as the average tenure of residence. And last but not least, we have realized gains on resale, and that's the difference between the current selling price less the initial previous selling price. So say I bought it for 300,000, I move out after 10 years, and then Summerset resells that unit for 600,000. So the difference is basically 300,000 between 600 and 300. So that is your gain on resale, and that depends on property prices as well as the demand for retirement lifestyle. If more people want to come in, then the prices will go up as well. So that's how the business model works. And this business model is very capital efficient, because every time a resident moves into the unit, they pay the cost of it up front, and then they reinvest it into the business. They use the occupant's loan. They call it an occupant's loan, an interest-free loan essentially, and they use that to build more villages. And so it's a very capital efficient model, and Warren Buffett really loves these type of businesses because he likes a business that doesn't take a lot of capital to continue growing, and Summerset is exactly this type of business. Secondly, let's take a look at the half-year report. So this is the most recent report. As you can see, Summerset's net profit after tax under IFRS is $92 million, and that's down by 5% from last half. So because of the way that Summerset makes its money, it's not an accurate picture using IFRS profit, right? Because IFRS profit includes a lot of unrealized property revaluation. So say, for example, earlier, I have that $300,000 unit. If property prices go up by, 10%, to 330,000, that 30,000 is unrealized because I haven't moved out, and Summerset can't realize that gain yet. So that is included in IFRS profit, but not in the realized profit. So when we look at realized profit, the more accurate figure to use is underlying profit here. Underlying profit, they made $47 million this half year, and that's a 6% increase from last half year of 45 million. So that is an accurate picture of the underlying business operations of the business. And so we can see that operations have improved even though IFRS profit is down. And as a long-term investor, we should be looking at the underlying profit because that is what measures the operations of the business. And ultimately, that is the realized gains that would be used to pass down to shareholders. Summerset has historically grew their earnings by about 30 to 40%. And so this paints a picture that Summerset has been slowing down. And that could be due to multiple factors, but mainly it's because of the slowdown in the property market. But I'll go into that a bit more detail later. And operationally, we can see that the total sale of occupation rights have dropped 7% in the half year. So in Q3, Summerset, delivered 165 units, 77 of new sales and 88 of resales. And this is a fantastic result. We can see the trend changing. So if we look at last year first, we had Q1 and Q2. It's increased slightly from 143 to 156. And then in Q3, it dropped from 156 to 148. And then it picked back up in Q4, 193. Now, when we look at this year, we see a small increase as well from Q1 to Q2. But in Q3, the trend continued and it's increased by another 24 units. When we're estimating Q4, management has already alluded to that they'll deliver about 350 units. So we expect new sales to be about 350. So that would mean that new sales for Q4 should be about 130 to 140 units. And if we see the resale figures, it's gone up significantly in Q4 as well. So if we project the same increase of about, say, 15 units, then we expect the total resales to be close to 100 and new sales to be as well between 130 to 140, which means that Q4 figures would be superb. It will be, it's looking to be very good. That's my expectation going into Q4. right? I expect about a total delivery of about 240 units. So let's go into why this business has outperformed, what the key competencies are. The first one is that they have a very good development strategy. They have a realized development margin, as I alluded to before, of 28.4% in the first half of the year. They have a target of 350 units in FY19 to add to their existing portfolio of close to 4,000 retirement units. And they have a very significant development pipeline of 4,800 units. They expect to have an average build rate of about 600 units for the next 2 to 3 years. And so that's a huge jump from 350 units in this financial year to 600 units for the next 2 to 3 years, right? They're ramping up their build rate quite significantly going forward into the next 2 to 3 years. And they have purchased land for their first Australian village in Melbourne. So they're expanding into Australia as well. And management has timed that really perfectly because now we see Melbourne's housing market starting to pick back up. And secondly, they have quality care service. So they focus on a continuum of care to meet the level of care required. So as you can see here, they have fully independent. If you don't need much care, but you still want to move in to make friends, that's yours, fully independent. And then if you need home cooking, you can get the supported living. If you need help with, cleaning yourself, then that's premium care. If you need nursing, that's rest home care. And, the most extensive care would be hospital care. So the entire continuum of care provided at Summerset. And I actually visited quite a few Summerset villages back in 2018, so just last year, and I spoke to one of the sales guys there. I asked him, why should I get my grandma to move into Summerset rather than the other retirement villages? And he told me that he was actually formerly working at Bupa, which is another healthcare provider, or another retirement village healthcare provider. And he said that Bupa doesn't offer that as extensive of a continuum of care that Summerset does, right? So Summerset offers this continuum of care, and essentially the transition between independent living to a more extensive hospital care is very smooth because you already are within the unit, you already are within the village, and you have already integrated, and so it's easy to move around, and Summerset can make that process seamless, right? Whereas if you go into other independent smaller retirement villages, they don't necessarily have that extensive level of care. And thirdly, they have an excellent management team. So they have an excellent track record for the past 8 years since listing, and underlying profits have grown at a compounded annual growth rate of 36% over the last 9 years. Julian Cook has been with the company for quite a while now, I think 7 years, and Scott has been for a number of years as well. And Scott is also a very smart man. He used to work at the IRD. All right, so they know what they're doing, and they're very good at it. All right, so now let's take a look at the industry and some of the competitors, some of the trends within that. Summerset is a company that's in a very favorable industry with a lot of tailwinds. People are getting really old in New Zealand because all the boomers are getting to an age where they sort of hit the threshold where they start moving into retirement villages. And you can see on this graph that population growth over 75 years and over is going to increase significantly. So in 2018, that was 6% of the population, as you can see here. And it will go up all the way to 16% of the population in 2068. So that is a significant amount of the population that would be above 75 years old. And we can see this chart. This is the baby boomers, right? The gray tsunami, they call it. Growth in this age group leads to a corresponding demand for housing. And the New Zealand aging population has an average penetration rate of 13%. What the penetration rate measures is the percentage of the population that occupies a unit at a retirement village. So currently 13% of the aged population are in retirement villages. As we go forward into the next few years, I do see the penetration rate increasing because there's something of a network effect, right? more people go into it, then there's more socialization that these folks could do, and that could increase the value proposition of moving into a retirement village, as well as it might be cool to move into a retirement village. So I do see the penetration rate increasing in the coming years, and if it does, then the demand for these villages will go up, and this would be a very significant tailwind for Summerset and the industry as a whole. A lot of the aging population are in Auckland. As you can see here, there's a big circle here in Auckland, and in the other regions as well. It's quite spread out across the North Island and the South Island as well. And if you look at where Summerset has their villages, it's basically around these areas, right? So we have a lot of completed villages in the North Island, where most of the population are. And you can see the proposed villages in turquoise or blue. I don't know what color that is, but a lot of it is in the North Island. So they are focusing where the aging population is. And so from this perspective, Summerset is well positioned to take advantage of the aging population, of the grey tsunami. And lastly, let's take a look at the housing market within the industry. So housing market has a significant impact on Summerset, because housing market determines how much Summerset can sell their units for. So per the REINS report, in September 2019, housing prices have increased 6.6% in September across New Zealand, right? So there were talks about a slowdown in the housing market, but we can see that in Auckland. Auckland hasn't moved yet. It's increased by 0.2%. So it's been relatively flat in Auckland in the past year. But all the other regions have been increasing. As you can see here, Wellington's increased by 6.3%. Gisborne up 12%. Bay of Plenty up 10%. Southland up 22%. So housing prices around New Zealand have increased. And because, as you can see before, Summerset is quite well diversified across New Zealand in terms of location, they're well positioned to enjoy that overall gain in the market, not just focused in Auckland. As we can see here as well, in Auckland, the number of days to sell is 39 days, and that's above the 34 days 10-year average. So in Auckland, we do see a bit of a slowdown, but across the other regions, the prices have still been very steadily increasing. Right, so that bodes well for Summerset being diversified across New Zealand. So let's have a look at the market competitors. The industry is dominated by a handful of big players. Despite the high levels of competition, the risk of oversupply is low due to the aging population, as mentioned before, and significant barriers to entry. Barriers for entry, especially for newer competitors, are the complexity of offering care services to residents and high capital cost requirements, as well as changes in law. So there was a pay equity settlement, I think a couple years back, where it made it difficult for small operators to survive. And we can see this in the closure of the Kohi Preston Rest Home, where they couldn't afford paying these staffers, and so they had to shut down. So this presents a barrier of entry for newer retirement operators who can't really offset these increase in wages through their property development profits. So it makes it very hard for smaller operators to survive, but it means that for bigger operators with economies of scale like Summerset, that they'll be able to gain market share over the long term. And we can see this in the trend. Summerset, being the purple line, has actually increased their total market share significantly from about just above 6% to close to 10% at 2018. So Summerset is really taking out the competition. They've been growing very significantly in terms of its market share. Okay, so now let's take a look at the valuation of Summerset. So Summerset, basically the share price has increased significantly in the past 5 years. So Summerset was $2.74 on November 21st. And to today, 5 years later, it's gained about 164%, right? So it's needless to say, it's a very satisfactory return for shareholders. You would have significantly outperformed the broader market. And if we look closer into the past year, there was actually a dip in June July. So this was a dip and it went to a low of about $5.40. And the reason why it's dropped was because of concerns of a downturn in the New Zealand economy, as well as falling or stagnating housing prices. So economists were all expecting a fall in housing prices, and so the share price went down. And so I recently re-entered my position at $5.57, so somewhere around here in August. 57, and yeah, now it's rallied up to $7.25. So when I wanted to make the video, it was around that price, but because I was busy and I had work and all that, I procrastinated a little bit, and so yeah, it wasn't so timely. Basically, that's what I'm trying to say. But let's go into a bit more of the valuation of the company and why it might still be a good buy at current prices, even though it's rallied about 30% since the lowest point in the past year. So this is a discounted cash flow model. It was basically just a simple calculator that I used online. I used to do a more comprehensive DCF approach back in the day, but I found that the results that I got is actually quite similar to this cash flow calculator online. You can basically Google DCF model calculator. So the inputs that I use are based on underlying earnings to get earnings per share. As I mentioned before, IFRS profit isn't necessarily the best indicator of actual performance, and so you should use underlying profit. The EPS that I got, 44 cents, I used the second half of 2018 and the first half of 2019 as your earnings per share. So I used a 15% compounded annual growth rate of 15% for the next 5 years. And which means that their earnings should double in the next 5 years. And I see this as very reasonable, considering that Ryman, the largest operator, that's their goal, and they have consistently delivered. And I see Summerset as a company that can grow faster than Ryman because of the smaller asset base that they have, as well as the more development extensive focus that management has on the business. So I see 15% CAGR as very reasonable, and you also have to take into consideration that this current performance, the current performance in the first half, you might have remembered that earnings have increased by 6%. I think it will grow more than that because that 6% is based on a weakened housing market. But now that we see the housing market is picking back up, and we also know that the development rate going forward to the next 2 to 3 years is 600 units per year compared to FY19 of 350. So development will grow significantly. And so that would that provides support for our 15% CAGR. We use a discount rate of 11%, and that's compared to the NZX historical return of 7 to 8% for the past about 60 years or so. And the reason why I use that is because Summerset has a higher risk profile than the broader index. So using the CAPM model, you'll get a cost of equity of about 11% with a beta of 1.4. We use a terminal growth rate of 2%. So that is consistent in line with inflation targets of the RBNZ. But that's also very conservative considering that the aging population, as mentioned earlier, is going to grow significantly. So I expect that, they are to grow more than inflation, right? So 2% is very conservative here. And when we put all that into the model, we get a fair value estimate of $8.40. And as at the current share price is $7.25, and this presents an upside of 15.8%. Now, looking at market comparables, Summerset is trading on an underlying profit of 101 million, and that is an underlying price to earnings of 16 times. As you can see, Summerset is higher than these guys over here, lower than Arvida, but it's also much lower than Ryman. So when we take into account profit growth, Summerset has demolished the competition. The competitors have delivered low teens of underlying profit growth, whereas Summerset has delivered 32%, which is much higher than the rest. I do have to say that Oceania, I used a 3-year historical profit growth because they were only listed for past 2 years or so. And Avida, they were listed 4 years. So I've used the 4 years underlying profit growth there. So, but overall, Summerset has grown faster than the rest. And they have a higher PE than these two, MetLife and Oceania, but the higher earnings growth justify the higher price to earnings ratio. And so the best way really to outperform the market is when you have expansion in the price to earnings ratio as well as increasing earnings per share, because the share price is a function of earnings per share multiplied by price to earnings ratio. And when I look at this, I can see Summerset's underlying price to earnings ratio expanding closer to Ryman as they get bigger and bigger and sort of move into that blue chip space. That's why Ryman has such a high underlying price to earnings, is because they're a blue chip stock, and a lot of these large index funds have Ryman stock, but not so much Summerset. So when Summerset gets bigger and they achieve this blue chip status, we can expect the price to earnings ratio to expand. And we know over the long term, Summerset's management has consistently delivered earnings per share growth. And so coupled with earnings per share growth and an expanding PE, this would deliver very significant returns over the long term. So now that I've hyped it all up, let's bring it back down to earth and talk a bit about the risks of investing in Summerset and some of the things you should look out for. So the first one is property market risk, right? When the housing market drops, Summerset takes a hit because the value of the housing market determines the value for Summerset's units. Regulatory risk. So, for example, if they were to implement a capital gains tax, but we know that this year the Labour Party has reversed their stance on a capital gains tax, that's regulatory risk. The increased cost of labour, that's also a risk as staff costs increase. This would cause a drag on performance, but because Summerset has a development unit as well, so their development margins do offset that increase in costs. And Summerset's management have actually been very diligent in keeping the cost of labour low. That's offset sort of by the excellent management team. Changes in the government funding model. The government funds these care fees, so if they were to change, this could impact Summerset's care fees that they receive. Development risk always as well. When you develop property, there's always development risk, project delays and holding cost risk, default risk and all that. And lastly, reputation risk. Performance and reputation could be adversely impacted should it suffer from any adverse publicity, particularly in respect of inappropriate care of residents or health and safety issues. So this is quite widespread actually in Australia. So not so much in New Zealand, but as Summerset expands into Australia, that's one of the risks that is there. There was a survey done by ANZ on the retirement sector. So they gave a survey to a lot of these managers within the industry. And what they found is quite interesting. In New Zealand, some of the risks that managements are looking out for are construction prices, higher wage demands, and the housing market. For Australia, the risks involved are legislation risks requiring mandatory unit buybacks, the state of residential housing market, and higher levels of compliance. And a top priority for both New Zealand and Australian markets is marketing and promotion, and that indicates higher competition. And the majority of retirement village operators expect to raise unit prices in the next 12 months, though this is more likely to be seen in New Zealand than in Australia. And that's good because, Summerset mainly operates in New Zealand. They only have one piece of land that they bought in Australia. So that's still very early days for Australia, and that would give some time for the market in Australia to recover. And if you'd like to know more about that survey, there is the link in the slide. So to sum up the video on Summerset stock, I'll give you a summary. Summerset stock is a stock with favorable long-term outlook. There's a lot of tailwinds involved within the industry. It has a very capital effective model, and they consistently generate a superior rate of return for investors through the competitive advantage they have in their higher development margins, their strong management team, and a high quality service. So I think Summerset is a great stock to buy and hold for the long term, and it should be a great addition if you're a long-term investor. So this sums up the video, and I hope you enjoyed content like this. This took me a long time to prepare and lots of hours researching this. So if you enjoy this, be sure to like and subscribe to start compounding your interest today. Until then, take care.